All right, it's Tony Hody here on Home Pro Radio, and today I have a wonderful guest in Julie Eccleston, and she's with Rocket Mortgage. And I was searching for a guest that was elite in their field and with somebody that was doing a lot of volume, someone that worked with an organization that had a lot of market share. And your name came up over and over again. A good friend John Savori referred you. We have some other friends in common. And so I'm so grateful to have you as a guest, Julie.
Well, I will take that as a compliment. I'm happy to be here.
Yeah. So we're here in early July and we're talking about consumer finance, right? And when I think of consumer finance and I think of 4th of July freedom, I think there's nothing more American than financing, right? we, we
Yes.
don't like to wait for anything.
Yeah.
Gas prices go up, interest rates go up, costs go up, and we still want to do what we want to do, right? We want
Yeah.
to improve our homes, we want to take vacations, we want to pay off debt. And so we wanted to get some feedback from you on some of this stuff because we know you're an expert in your field.
Yeah, absolutely. Love talking about it.
Yeah. So give us a little background. How long have you been with Rocket now?
Great question. So I started at Quicken Loans, now Rocket Mortgage, in April 2007. So if you've ever seen the movie The Big Short,
Yeah.
it was literally like 2 months before the market crashed, which was definitely an interesting ride. I think my family was really worried about me at that point, but
Believe it.
ended up being a really great opportunity to walk into. So I've been there just over 19 years. Love it. Have held a lot of different hats. Was an underwriter at one point, was a senior director overseeing a fairly large purchase team, so helping clients buy homes. And now I serve as an executive loan officer and sales manager. So I spend my day reconnecting with my past clients, working with partners, working with, folks not only here in Northeast Ohio, but across the United States, either buy homes or improve the homes and improve the financing that they're in now, which has been really awesome.
Awesome. So I have some notes here with different questions because there's just so many that I
Yeah.
have. And I was curious, what types of mortgage products do you guys specialize in at Rocket?
A little bit of everything. So whether that is conventional, so Fannie Freddie, the big mama and papa of the mortgage industry that make all the rules, those are conventional loans. FHA, so through the Federal Housing Administration, and then VA through the veterans. We also have a lot of what are considered non-QM, and all that means is they don't fit into one of these four categories. So they're kind of like choose your own adventure investor guidelines, which tend to be really great for non-traditional. So 1099 clients, maybe clients whose income isn't fully supported by their tax returns, or investors, things along those lines. And we also do quite a bit of DSCRs and second mortgages. We're seeing a lot of clients tapping into equity using second mortgages in today's day and age. So we really kind of run the gamut of a lot of different products that we can help with.
So that brings up a really interesting point.
Hmm.
The second mortgage thing, I think, we talked about it before we
Hmm.
went on air. And, there's a lot of folks out there that had a great interest rate, like an unreasonably low interest rate during, COVID or pre-COVID. And, since that time, rates have gone up
Hmm.
and people don't want to touch that main primary mortgage. So they're doing second mortgages
Hmm.
and they're doing HELOCs or home equity lines of credit. What's the difference between a second mortgage and a home equity line of credit? Are they the same thing or what are the
Yeah.
differences there?
So if you want to take equity out of your house, there really are kind of three ways you can do it. So one, you can do a cash out refinance. One new loan, one payment, you pay off your existing loan and take whatever else you need. And as you had mentioned, people who bought their houses a while ago, maybe not as attractive because they're giving up some of those low interest rates. There's a home equity loan, which is a fixed rate. So 10, 15, 20, 30 years. Great. At the end of this time, your payment's the same, the rate's the same. You pay it off. And then there's a line of credit. The best way to look at a line of credit is it's like a big credit card tied to your house. So just like a credit card, it's variable. You have an interest only payment. You can always pay more on it. You pay it down, you borrow against it for a certain amount of time. And then at some point they say, yes, you do actually have to pay this back. So usually after 10 years. But those are kind of the three different ways you can tap in to use your equity if you're looking to do projects or you're looking to do consolidations.
Yeah, that's great clarity on that.
Mhm.
I'm curious, what's most popular right now?
So we help a lot actually with fixed seconds. I recently have been helping a lot of clients with consolidations who maybe they had personal loans or credit cards or want to do renovations. And I am a firm believer that if someone's doing a straight consolidation, right? Like I've got a lot of credit card debt, I've got a lot of like just personal loan debt, that you shouldn't put that on a line of credit because that's kind of what got you here. I mean, there's probably a lot of other things that got you here, but using those lines of credit, not thinking about it, or maybe just paying minimum payments and having it escalate, get you to the point where sometimes that accumulates. So putting that on something that there is like, great, no matter what, you're having this paid off in, 10 years or 15 years, I think is a better strategy. If someone is doing like, hey, I know I want to do a repair or I want to do an upgrade and it's going to take a long time. So I need a little bit of money now. I'll need a little bit of money later. Then something like that, sometimes a line of credit is a better fit for, just depending upon how they want the money or how they're going to use the money.
Got it. And as far as rates are concerned, we talked about it, they were unbelievably low
Yeah.
leading up to COVID and during COVID. And since that time they've jumped a bit. But I mean, is it really a new normal? I mean, what's the climate like?
Yeah, people do not like my answer to this, but the answer is kind of yes. So and I'm kind of a nerd in a really great way. But if you look at like economics and you look at people much, much smarter than I am, and when they say, hey, in an ideal economy, now I think we can all agree we're not in an ideal economy, but in an ideal economy, you should on a 30-year fix be somewhere between like 5.25 and 6.25. Well, there's been a lot of times in the past 12 months that we've been there, that is a realistic expectation on a 30-year fix. Right now, because of everything happening geopolitically, a lot of things happening obviously with inflation, they are a little bit higher as of July. You're probably more mid upper sixes on something like a 30-year finance, but that is within the general range. I think what happened for perception is one, so many folks are at those like 2.99, you're out of your mind, like 2, 3, 4%, and love that we took advantage of it. And boy, did we take advantage of it. And I think that is amazing. Sometimes we strategically forget about like what the rest of the life would look like and that we were like locked into our houses to get ourselves there. But being in that position and then having such a large upswing, because rates really did go from like 4%, brief at 5%, and then like 7.5, almost 8%. And I think that's what's kind of scared a lot of folks. And they still think about like, oh my gosh, I had this, I don't want to be at 8%. When in reality, you probably are somewhere in the middle. And if you can be somewhere in the middle, that's actually good financing. That is actually where you should be.
Yeah. So I'm curious, the breakdown of second mortgages and first mortgages today. I mean, obviously, when rates go up and,
Mhm.
there's increased gas costs or inflation, a lot of times you see a slowdown in new mortgages and new home purchases, things like that. What are you working on today? Is it a far more equity
Yeah.
line of credits and second mortgages, or are you?
It's a little bit, I would say that if I looked just at my personal business, it's a third, a third, a third. It's like a third purchases. It's a third home equity loans helping, past clients or new clients, and a third refinances. Because there are still instances where just doing a refinance and a full cash out makes so much more sense. Because even, let's say you owe $50,000 at 3.5%, right? But you want $200,000 because you're going to do this massive renovation. Well, if you do a second mortgage, you're going to be higher. You're going to be maybe 7, 8, 9% in terms of an interest rate. So your blended rate, what you're actually paying on your money, would be so much higher than if you just did a refinance. So when you are evaluating like, okay, well, how do I finance this, or how can I use my equity or my home to do this? I would say look at all the options and work with a banker who's going to be like, we'll look at this, we'll look at this, we'll look at this, and then we'll make the decision of what's going to make sense, as opposed to, hey, no, you're just going to get this. Because a lot of times clients will say, I don't want to lose this 3%. I don't want to lose this number, when in reality, they're costing themselves more because they're just paying so much higher if you are going for a secondary product. Second mortgages, lines of credit do tend to be higher than what just a primary is. And that's a risk thing, right? All of life is based off of risk. If God forbid something were to happen and they were coming back after your house, the first guy's getting paid off by the second guy. That second guy needs a little bit more to say, yep, I'll take that risk and I'll take that second lien position.
Yeah. So that's interesting. I mean, it sounds like it's a case by case basis. Like you
Mhm.
really need to look at someone's complete financial situation, what their goals are, how long they plan on staying. Are they paying off debt? Are they doing home improvement? Like, what's the purpose?
Mhm.
Is you feel that's the case?
I do. I think in today's always, but really in today's day and age, um, it's not a t-shirt, right? We're not a one size fits all type of a situation. And yeah, there are some commonalities between, situation to situation to situation. But for me, if I'm making one of, if not the largest purchase I am ever gonna make in my life, which for most people that is their house or is real estate, whether it's a second home or an investment property, like I don't want just one thing. Like, I want someone to know that that's the thing for me, right? Just like if I'm going into the doctor, I don't want them to be like, yeah, take this because everybody gets this. Like, no, I want you to do the test and dig deep and ask me the questions because I want to make sure that you're putting me on the right protocol and I'm going down the right path. And from a banking perspective or a mortgage perspective, having that same conversation with someone who's going to take that level of care and say, let me peel away like the layers of the onion a little bit just to make sure at the end of the day, you are getting the best thing for you and the thing that makes sense. One thing I think is the most common misconception is that everybody is we as consumers are conditioned to call and say like, well, what's your rate? Over here you might get like, well, what's your cost, right? And that's always the worst question to ask because that doesn't always mean
Yeah,
best,
price doesn't equate to cost,
right?
right?
Or value.
Rate doesn't equate to long-term cost,
Yeah.
right? And I think people get stuck on stupid for lack of a better phrase,
Yeah.
right? But you mentioned something, the word misconception,
Hmm.
and there's a lot of that in home improvement and home lending. And I'm just curious, what other misconceptions do you think people have about interest rates, about the mortgage industry, or, the current climate?
Yeah. I think anytime you are in a service type of a role, right? So construction, mortgage, any of them, there's always this level of distrust. And a study came out, and so don't quote me verbatim on this, but I want to say it was between 60 to 70% of like first in a long time home buyers did not trust their realtor or their lender.
Wow.
Which for me, like, really kind of breaks my heart because I'm like, oh man, like I show up and I believe 95% of other people show up every day wanting to do the best thing for that other person across the table or on the other side of the phone. But with what I love to refer to as the TikTokification of finances, of just really knowledge in general, I think that there's so many differing perceptions or opinions or advice that it puts us into a place that we like shut down. And so we don't trust. And I think that one misconception is that that other person on the other side of the table is just trying to take advantage of me.
Right.
I think that that is a really big misconception in a lot of different things. Two, I think the interest rate is the most important thing, kind of like we talked about.
Yeah.
You know, a lot of times there's people don't always remember there's a big difference between interest rate and interest paid. And you can pull those levers of different terms to pay less interest overall. Like, look, I am Midwestern, fiscally conservative. That is my very nice way of saying I am cheap. I don't want to pay more than I have to, and I don't want anyone else to either. But understanding where some of that value is, and then understanding that like if you are applying for something like a mortgage, like you're probably going to have to answer some questions. That a lot of times people are like, why do I have to tell you my income, or why do we have to look at our credit? Of understanding that there is a process to make sure that you are qualifying for the best thing that you deserve.
Yeah. So obviously, we're in the home improvement business,
Mhm.
and as the president of Window Expo and Bath Expo, we do a lot of remodeling, and oftentimes it is being financed by the consumer. They don't always tell you. They tell you they're paying cash, but
Mhm.
we know that they're probably using a home equity line of credit, that type of thing. Are you seeing uh, a lot of consumers, a lot of your customers using the refinance to do updates since interest rates are higher and they're not likely to move? Are they remodeling a lot more than usual?
Yeah, I think that clients are staying in their homes longer than they used to. I feel like back in the day being like when my parents bought their first home, right? They lived in that house for 25 years. And I think that generation, my grandparents, kind of the same way. They bought that house, they were there for 40 years. That was a trend generations ago. I think my generation probably got into this trend of like new upgrade, shiny, pretty, like we'll just sell and move. We'll just sell and move. And like you could do that, right? There were like a climate, an economic climate that you could do that. There were options as far as like houses that you could do that. Well, a lot of that for a lot of different reasons is not there. Whether it's, hey, I feel locked in the rate lock effect. Like I don't want to lose this, so I'm not going to move. And so I'm going to stay put. Or even if we look at the explosive appreciation that has happened in homes, even if you could buy this house in 2019 before COVID and before we really saw things ramp up, that same house now that you would have been able to buy, you might be priced out of because it's 50, 60% more than it would have been in a very, very short time where wages and so on and so forth didn't keep up and inflation, gas, groceries are more expensive. That leap may no longer be a leap that you can make. So what do you do in those instances? You're not stopping having kids. Like there's going to be more. You gotta find somewhere to put them. We're seeing a lot more like multi-generational living of, parents coming to live with now like adult children, and aging in place and things along those lines. Well, then you remodel, you take that. I also feel, and maybe this is just my personal experience, but after COVID, COVID isolated us in a lot of ways, but I feel like it also made us appreciate our neighbors and appreciate our communities. And coming out of that, I find a lot more folks saying like, I want community. I want to be in a community. I want a neighborhood. When I bought my house with Meredith Hardington, who I believe is either been on or will be on your podcast,
Yeah.
she will tell you the first question I was like, before I even look at this house, I need to know, do they have a block party and who's going to go on a walk? I'm like, just tell me about my neighbors and I will figure the rest out after, because you can change a house. You can't always easily change a neighborhood.
That's right.
So having those and just being able to say, great. And my neighbors across the street are a perfect example. Actually, you guys may have worked on that house where they had 2 young kids. I mean, and it was a beautiful, adorable little starter house, right? And it had gone through a couple couples who then, great, we got married, we bought this house. Okay, now we're starting to have children. Yes, 1 is okay. Okay, now we have 2. Now it's too small. We can't stay there anymore. Now we've got to move, right? So they went and they were going to do the same path. Like, okay, we're going to look in Rocky River, stay in the same school district, and couldn't find anything that, 1, met their needs, and 2, was at a price point that they wanted to afford, not even they couldn't afford it, but that wanted to afford. So instead they did a massive addition and they put on a second floor. And, as their family is growing and as their opportunities are growing, their house now can grow with it. So it is a house that they can. And I think a lot of families and homeowners are kind of leaning into that of, hey, I like all of these other things. I would like to stay. So let me do it. And a lot of us spent a lot of time looking at our same walls for 2 years when we weren't allowed outside. That kitchen, even if it's beautiful, probably just, it needs a little bit of a refresh.
Yeah. Well, it's great that you guys are able to facilitate, some of these projects because let's face it, like the one you described with a huge addition where you're putting a second floor on a home. I mean, that requires some funding. And most people just don't have that lying around between the seat cushions. I mean,
Yeah.
you're going to have to refinance. You're going to have to do a second mortgage. You're going to have to do something to make that affordable.
Yeah, 100%.
So I'm curious, we talked a lot about interest rates and things like that, but I'm curious about tax benefits and tax deductibility. That's something that a lot of people have questions about. And, when it comes to doing a second mortgage, if you are consolidating debt, if you are remodeling the house, if you are taking a vacation, is that interest tax deductible?
So it depends. And I would say in those instances, definitely get a CPA. I am not a CPA, so I'll give that as my caveat. I know enough to be dangerous. But if it is for like home improvement and home related, often that interest is tax deductible. If it is not, it usually is not tax deductible. There have been some changes, and I believe that there will be more changes coming down as far as that particular. Now, that is on a second mortgage. On a first mortgage, your mortgage interest, regardless of why you do it, is tax deductible. So, and you would get a 1098 at the end of the year. And so that would be something that I would definitely say work with, a CPA, or even if it's like an H&R Block, and have them look at it to make sure that you are getting all of the advantages.
So there are some benefits. So even if you do refinance and you take the interest rate up a little bit,
Mhm.
you're also going to have increased tax deductibility with it.
Mhm.
And so that's great.
Mhm.
But yeah, we're in the home improvement business. And so as we understand it, again, I'm not an accountant or CPA or anything like that. But yeah, a lot of those projects can be tax deductible, which is a benefit that a lot of people don't understand.
Yeah.
And you take things like energy savings, you take things like tax deductibility, and it starts to really eat away at the initial cost of doing something like that.
Yeah.
And then, of course, you mentioned appreciation's been phenomenal.
Yeah.
So people's homes are going up in value. So, from that standpoint, it's been a great time to remodel.
Yeah. Especially here in Northeast Ohio, we are in still a very strong appreciating market, that homes are still appreciating 5-6% a year. Other places can't say the same, but being here, we are very fortunate that you're going to get your bang for your buck, so to say.
So this acronym HELOC,
Mhm.
which stands for Home Equity Line of Credit, this is an acronym that I just started recently hearing in the last couple years.
Mhm.
Is it different from a traditional equity loan?
Yep. So you've got a HEAL and a HELOC. A HEAL, or home equity loan, is just a fixed term, fixed rate, fixed amount loan. You pay it back. So just like it would be like a mortgage, or maybe like a car loan of you've got this, you paid this, it's done. And then a line of credit, that's where it is revolving. So you pay, you take out, you pay, you take out, and you have a limit. So very similar to a credit card. One of the biggest differences, not just in how you pay them back, is in interest rate as well, or the interest that you pay. Lines of credit don't necessarily have a cap. So your payments and your rates can be different depending upon what index they are tied towards. So there's a lot of different indexes out there. If it's like the LIBOR, which is one that you hear a lot about. So as that changes, your rates can change as well. So there isn't always as much of a cap or a protection if things were to go really haywire. It can really work really, really well in your favor, and maybe some days not really work well in your favor, depending upon, what the markets are doing.
Got it. So, who do you think is an ideal candidate for a HELOC? Is it just on a case by case basis?
You usually have to have better credit, right? So second lien products usually will require like a 680, 700 or above. And then you do need to have equity. And most of these loan products are also income documented. So you would have to be able to verify your income. There are some instances, not that we have, but out in the marketplace, where it's kind of self-stated income, as opposed to like, actually, hey, here's my bank statements or tax returns or W-2s. Um, versus, there are some difference with refinances. So a lot of times why I will have clients do one versus the other will be, credit. Even if a home equity loan makes more sense, if they don't have the credit to be able to do it, that is the alternative. Like, to do a refinance is the alternative.
So, one question I think a lot of people have is, if you have $100,000 in equity in your
Mhm.
home, how much of it can you actually use? How much can you access?
Yeah. So a lot of times, most loan products will cap you at 80%. So 80% of whatever your house is worth minus whatever you owe on a first loan. So let me give you an example. Let's say your house is worth 500,000. 80% is that is 400,000. You owe 300,000 on a first mortgage. You've got that 100, between 3 and 400, that you can take and you can utilize. There are some instances, like on a second loan, we have a home equity loan product that if you've got good credit, you can actually go up to 90% of that you wouldn't be able to do on a traditional refinance, but you can. The one exception to all rules is a VA loan. A VA loan actually allows you to go up to 100%, but that is only for veterans. Um, if you had 100,000 in equity, then you probably could take like 80,000 of that out
Okay,
and be there. There's a lot of different kind of creative ways you can look at it.
that's great. But, people can access that that equity and put it to good use.
Yeah.
So, can borrowers use the money however they choose? Like, again, there's a variety of different things that people might want to use the money for.
Mhm.
But, can they take it down to Jack Casino and just go crazy?
I mean, if they want to, they can. So depending upon your debt ratios, and your debt ratios are just simply like how much money you're bringing in versus what you're obligated out on a monthly basis. So unless you have to specifically pay off debts in order to get that ratio in line, yep, if I give you a check, that is your money. We would have talked about it, and I'm going to hope that you're going to use it for like financially responsible things. But at the end of the day, that's your money. You can do with it what you want.
Yeah. Do you find that, borrowers today are more sophisticated, with ChatGPT and Grok and Gemini and all these resources? Does that make your life a little easier that they may be a little bit more sophisticated, understand things, or can it confuse them even more because there's just
Yeah.
so much information out there?
I think it's more confusing. And I think it's just more confusing because you're now ChatGPT is like my bestie. Like I do love it and I use it for everything. But the one thing with a lot of those programs is it's pulling information from a lot of different places, but it's not necessarily fact checking it of whether or not that's correct or that's true or that is like accurate information. Um, so I think it makes a more educated conversation. And I'm an educated borrower is my favorite type of borrower, right? Like one that
We say that all the time.
one that actually is like thinking through their decisions. I remember when I started very early on and I would be helping clients, whether it's, refinance or buy, and they wouldn't even ask questions. They would just sign documents. Now I know that I'm like a great, honest person and I'm here with great intentions, but I know there's a lot of people that sit in a seat like mine who maybe don't look at the world the same exact way. And that always just really surprised me that someone would be like, yep, okay, great. Let me sign my here. Great. Give me $300,000. Amazing. With really not, not understanding, or not really kind of leaning into what you're actually signing. So I think that clients do ask more questions now and have come with a little bit more. We talk a lot in the mortgage world that like, look, somebody knows all about you before they call you. They've already looked you up on Instagram. They've already looked you up on LinkedIn. They've already, checked out community pages. That's the unavoidable,
Right.
right? Um, so they've already done their research before they
Yeah.
pick up the phone. And younger generations really don't want to be on the phone, so they really have already checked you out and have done all of that.
Yeah, that's for sure. That's why, we work really hard at keeping our reputation pristine.
Mhm.
We believe reviews equal revenues, right? If you've
Mhm.
got great reviews, the phone's going to ring and people are going to want to do business with you.
Yeah,
Do you find that to be true?
I do. I mean, it's you want to make sure that you are kind of going back to that distrust before, that you're leaning on someone who's had a good experience, right? And even in the mortgage world, I want to say like 70 to 80% of mortgage lenders are introduced to a client through like a real estate agent. And that's the lender that
Yeah.
they use, is because, hey, this person that I'm trusting to find me the right house is saying this is a person that can get the job done.
Yeah.
Right. So that's a relationship that I want to be in. So.
Yeah. Yeah. I think having a referral is, it's such a testament to,
Mhm.
of trust.
Mhm.
I wanted to talk to you about the difference between good debt, bad debt. That's a topic that comes up from time to time. And obviously, with homes increasing in value, home improvement, remodeling, renovations can be perceived as good debt versus other types of debt that might exist. Are there any better rates or are there any advantages to doing renovations?
Yeah, I think that when you're looking at your credit score, that's where you'll really see like good debt versus bad debt. Like good debt being mortgages, installment loans, long-standing lines of credit that have been paid back on time, versus if you have, judgments, collections, bankruptcies, those are really like bad debt.
Right.
And depending upon your credit and your overall credit profile, you will get significantly better or worse terms. I always equate it to like, look, if I go out to brunch with my girlfriends and I put it on my bill and I ask everyone to Venmo me, I know the friends that I'm going to have it before we leave that table. I know the ones I'll be in the parking lot, and I know the ones that like, hey, you're welcome because I'm never going to see this money again, right? And so like the next time you go out, you're probably going to decide differently, like whose tab you're going to put on your bill.
Right. Yeah.
And it's the same way with kind of like credit and lending. Um, if you think about it, we're just making risk decisions. We are literally putting money where our mouth is. So if I say, okay, great, I'm going to lend you this money, it's because I think that you're going to pay me back. And the part that I always find is most interesting is that, like, really credit in the world of lending and mortgages wasn't a thing until like the late 80s, which is really not that long ago. And before that, it was just like, okay, that guy gives me a good vibe. I think he'll pay me back. Whereas now there are those models, one, to kind of help guide those decisions, but two, also eliminate discrimination, right?
Right.
In being able to say, here is your pattern, here's your history. This is why you should and can get this rate versus that rate.
Yeah, you brought up an interesting thing about, lending really just coming into the forefront of consumer behavior in the 80s. Mike, you might want to check this for us, fact check this for us, but I believe it was in the early 70s, mid 70s, before a female could have a credit card. Do you know the date on that?
I want to say it was 1975.
That is staggering.
I know.
Unbelievable.
Well, and I talk to a lot of like younger women, and even my niece is a junior in college, and we had this great conversation probably a year or so ago where I was like, look, like when grandma was your age, like she could not get a credit card without a man signing off. Like she couldn't get a mortgage, she couldn't open a bank account, like, and that is not that long
Right.
ago. Which is why I also think now in today's day and age, single women are one of the biggest quadrants of first-time home buyers.
Yeah, I've seen that stat. And obviously, we pay attention to stuff like that. Being in the home improvement business, we want to know
Yeah,
who our customers are and what the future looks like. And yeah, that's really interesting
yeah,
to see that.
yeah.
I'm curious, we talked about consolidating debt and what bills does it make sense to consolidate and what maybe might you want to leave out of that equation?
So I think when you're looking at consolidation and when I have really looked at consolidation with clients, it's usually when they have quite a bit of debt. So something probably has happened. Most people don't get there by accident,
Right.
right? So whether it's like an illness, maybe there was a death in the family, maybe they're supporting like an older adult child that they've maybe gone through a divorce or something along those lines, and parents are amazing, and will do those things. But with credit cards, and credit cards aren't bad, right? Like I've got them, I use them, I love them. But the interest rates on credit cards are so high. On average, even if you've got good credit, you're like 22 to 26%
Unreal.
if you let that carry over and you carry a balance.
Right.
And so, what most folks don't realize, especially in a world, and I am just as guilty as the next, where amazing. I buy something on Amazon, it shows up at my door, that credit card gets auto paid. I never actually feel the pain of that bill or buy things just magically appear,
Yeah.
right? It doesn't mean I'm not paying for them. It just means I have been so far removed from that system of understanding like, okay, this is really my hard-earned money that I'm paying. And so what I would say is most don't realize that like if you have a credit card and you are just paying minimum payments, it will take you 30 years to pay that off.
It's
It
great.
really is like having a 30, and the interest rate on that is so much higher than what you would have on like something with a line of credit. If you've got like 5,000 in debt, $7,000, 10,000 in debt, there usually you don't want to go tap into your equity and you don't want to do that. It usually has to make sense and run the numbers. But if you have, 30, 50, $70,000 in debt and you're now paying two, three, $4,000 a month and minimum payments, which we do unfortunately see not all the time, but more often than one
Sure.
one would hope. If you can take that and turn that into a home equity loan payment, maybe on 20 years for like $600, like that's a life-saving change for someone.
Definitely.
Now, the second piece to that is the as Americans, we don't always do, and I have a lot of thoughts on Americans and finance and education, um, is stopping that. Because if you do that and then you just keep using that credit card and you do it again, you've just
Yeah,
compounded
you
the
gotta
issue.
curb the behavior that got you there in the first place. If it was an incident or an event, like you
Yeah,
say, then that's understandable, but
yeah,
if it's bad behavior, that
yeah,
bad behavior is likely to gonna continue
yeah.
unless, you somehow you do something to intervene with that.
And it only is within the past couple of years that financial literacy has become a graduation requirement. In many states, not even all states, but Ohio is one of them, where now, in order to graduate, you do have to do financial literacy, which I think is amazing and long, long, long overdue. But to that point, if you are not in the buying process, right? Like Amazon example, it's really easy to forget that, by the way, you're gonna get a bill for that. A
Yeah.
and if you are like my house lately and you have Amazon packages showing up every day, that bill's gonna get real expensive real quick, so
Yeah, I mean, if pro athletes who are earning tens of millions, hundreds of millions of dollars can get into financial trouble because of their lack of understanding,
mhm,
then the everyday consumer can find themselves in the
yeah,
same spot as well.
yeah,
Yeah.
and that is something that I'm very, very passionate about is, like, financial education and understanding, like, why we make the decisions we do and what does that all relate to, and it is nice, like, you are starting to see that that is more of a topic of conversation,
Yeah.
whether it's becoming more mainstream to really think about why you make the financial decisions that you do.
So I want to talk to you about mistakes. I mean, that's kind of what we're leading up into, right? I mean, getting in a place where you don't want to be. What mistakes do consumers make, homeowners make in the refinance process or in the, when considering an equity line of credit or anything along those lines? What mistakes are common that people want to avoid?
I would say one, really make sure like the juice is worth the squeeze, right? There's always a cost associated with financing. One thing that I talk to my clients about is what is their recoup time? Like if you do this, and how many months are you getting your money back for doing this? And if it's not in a reasonable amount of time, then you just shouldn't do it. I have a lot of clients, and I'm very close to my past clients. I talk to them quite a bit where I'm like, no, you shouldn't do this, right? Like, we're not going to do this right now. We'll do this when it hits this. But if they're just looking to save money or just looking to like refinance, sometimes when it's like a consolidation or things along those lines, like you have to do it, right? Like
Sure.
now is the time that we've got to do it because of these other factors. So I would say just really understanding your terms and asking questions and like making sure that it makes sense and that you've got a good recoup. Good recoup, I would say, is like 2 to 3 years if you're going to be there longer term. If you're like, "Hey, I'm gonna, move in a year," then obviously, like, that's not a good deal. That's not, something that you should do. I would say, you know, asking questions, that I think is, like, the biggest mistake of not and withholding information, right? A lot of times we become so guarded, we don't wanna share all of our, like, deepest, darkest financial secrets.
Right.
And even if asked, we'll kinda, like, skirt the issue with a question, but knowing that that other person on the other end of the phone or the end of the other end of the table, like, they really are there to, like, facilitate and help you. So to make sure that you are giving them that information.
You brought up an important point because we were talking about this before we got on air.
Mhm,
And, do you think people should ask AI questions? Because, I know a lot of reasons why people don't ask questions. They're afraid of judgment, right?
mhm.
You know, it could be that they have debt and they don't want to share that, or that, they can't document income or whatever it might be that they might have shame around. Asking Chat GPT or Gemini, there's no judgment there for sure.
Yeah.
Do you think that's a good idea for people to get at least get a starting point?
I think to talk it out. I mean, I talk to my ChatGPT about everything. Um, to at least, but not to take that as gospel. Because again, because we are still relatively in the early stages of AI, sometimes the information it's pulling from is not actual.
Sure.
But sometimes if I'm like thinking about something or I'm trying to work through something, I will ask it to pull resources for me, or I will ask it questions and be like, hey, give me like 5 different things so that I can then use that information to make my own decision. And I think those kind of things are great. But sometimes, like, hey, tell me what this, or this is, like, That, you know,
Trust but verify.
trust but verify. And we're also in this place that with AI in particular, that just because something or someone shows up on AI doesn't mean that they are the best, because how it pulls the information. And
Sure.
ChatGPT is a perfect example of that. Of it's usually the person that's primed the algorithm, not necessarily the person that's done the work
Yeah.
or done the good work. And you can manufacture so much in today's day and age. So
Yeah, we've been surprised by that. So obviously we do a lot of searches here where we're like, who's the best replacement window company in Northeast Ohio? And based on reviews, it should definitely be us. But
yeah,
we don't always show up number one
yeah,
on the various AI platforms, whether it be for Bath Expo or Window Expo. So we're working on that, but
yeah,
we're surprised to see that it's not always what's true and accurate. That there are other things that feed those algorithms.
yeah.
So one question I think a lot of people have is if you have $100,000 in equity in your
Mhm.
home, how much of it can you actually use? How much can you access?
And things that you would never think that is where that is where it's pulling from. So I like AI. I like ChatGPT. I really do use it for everything. Um, but take it with a grain of salt and use it to then make your own opinions. But if you're really wrestling with something and you're like, I do not want to talk to another human about this right now. I'm not yet at that first point to at least like start thinking through it on your own so that you can knowledgeably go into that conversation. I think that's a good idea.
I like to check things on different platforms too, because it's amazing how you'll get a different answer
Yeah.
on one platform versus another.
Yeah.
And sometimes you get valuable perspective from,
Yeah.
seeing it from two different angles. So that's certainly something to consider as well.
Yeah. That's a good point.
So are there any myths you think about, mortgage lending that consumers
So
or homeowners? Yeah.
yeah.
What do you think would be the top three maybe?
I think if you're looking at buying a house, that you need 20% down. You don't, especially
I
if you
saw something you guys have like a 1% down.
yeah,
That's great.
a 1 plus,
That's incredible.
where it's 3% down, but we give you a lender grant for 2 of it. So 3% down is a first-time home buyer. Like, the average first-time home buyer probably is somewhere between 3 and 6%. And even, like, a returning homeowner is somewhere probably between 10 and 15, because housing is so much more expensive than it was even 5, 6 years ago. To save, 20% on a two when that house was 200 versus 20% when it was 300 or 400 are two totally different numbers. So one, that you need 20% down to like start the journey. Um a big misconception for refinancing is that you need to drop your interest rate 2 points. I think we're starting to like get away from that one a little bit. But when the average loan size was, 75,000,
Right.
100,000, yeah, you probably, and interest rates were 13, 15%. Like, yes, in order for you to make a noticeable difference, you have to. I mean, general rule of thumb is like one, it's got to be better. Um but two, usually if you can drop it a half a point, you're going to be saving yourself a significant amount of interest. And to that point, a lot of the clients that I work with, we take them from 30 years to 20 years, right? So you don't always have to refinance at a 30-year, which I think is also a misconception. One of the best ways to pay less interest is to look at shorter terms, because there really is a big difference between interest rate and interest paid. No matter what your rate is, you're always going to pay the most on a 30-year loan. You pay all the interest up front.
Yeah.
So if you take those slightly shorter terms, 15, 20, 20, even 25, you're cutting off some of that front-loaded
Yeah. I've
interest.
definitely been shocked at how much time you can cut off a loan with
Yeah.
a minimal difference in payment.
Yeah.
So that's good advice there.
Yeah.
So what haven't we talked about that maybe we should?
What haven't we talked about? I think another misconception is that interest rates will go back to 2%.
No way.
I really think, and I hear that a lot of like, I'm gonna wait. And I actually had ChatGPT help me with this, because I was like, do this calculation for me. If you buy a house today or you have a $300,000 mortgage today at 6%, your payment, just mortgage, so not taxes and insurance, would be just shy of 1,800. If you were to say, you know what, I want to wait for interest rates to go down, and that house continues to appreciate. So let's say now you're taking out a $380,000 loan, but you get it at a 4%, your payment's actually higher.
Yeah.
So I think that waiting thing is that doesn't mean everyone should go out and buy a house today, right? But it does mean that you shouldn't let mortgage rates dictate whether or not you should make that life decision. I think life should dictate that decision, and mortgage rates will be what they will be, and they will change. They will go up. They will at some point go down, and it's just a matter of like riding that wave and understanding. My husband and I have owned our home for 13 years now. I am in the business, so I do understand. But I think we're on our sixth loan
Wow.
because we just took advantage of like
Yeah.
when those opportunities came up. I mean, obviously, I would know probably more than the average bear of like when those opportunities were there. And
Yeah. No, that's interesting though, because we are in the exact same boat. We get customers all the time that say, you know what, we're going to wait until interest rates drop before we remodel the bathroom,
Mhm.
right? Before we replace the windows and doors. And it's just like when you think about how much the windows and doors are going to cost 2 years from now
Yeah,
and how much lost energy savings and you know
yeah,
there are other benefits and just comfort of being in your home during that
yeah,
time. So it really a lot of times doesn't make sense to kick the can.
yeah,
If it's it needs to be done and you're going to do it eventually, you really have to take a look and do the math both ways because it's probably better to go ahead and bite the bullet.
yeah. And the only other thing that I think I hear a lot is, "I wanna do this for resale value." Right? And I can go with 2 schools of thought on that, right? Like, do the things for you and do the things for you for future you.
Right.
I have a client and they're dinks, so dual income, no kids, right? They have adult children who I think were out of the house now. And they bought this like adorable little house and she was like, "I want a big old closet." So they took this 3-bedroom, turned it into 2-bedroom, and that other bedroom became her closet. Now, for retail value or resale value, was that the best decision? Maybe not. A 3-bedroom is usually gonna sell better and
Yeah.
quicker than a 2-bedroom. However, if it makes you happy, you should do it. And I think that that is something that I talk to a lot of homeowners that they get stuck into of, I only want this because of resale value. Enjoy it while you have it and enjoy it while you're there because like a lot of families learned in 2020, you might be there longer than you thought that you were going to. So have it work for you and have it the way that you want it.
Yeah, I think that's a really important point because we have a lot of customers that would love to lower the threshold in their bathroom, take a tub out, put a walk-in shower in, and their primary motivation for that is safety, right? They
Mhm.
don't want to. It's difficult as time goes on to get in and out of a high threshold bathtub, and so they would prefer to put in a walk-in shower. However, they have this misconception that the next homeowner, it might have children and they're going to want to bathe those children in a bathtub when in reality that's just not the case. There's a lot of new inserts and things that you can set inside a shower that keep an infant safe and still allow you to use it in a tub like
Mhm.
manner. So yeah, we see that people aren't doing what they really should be doing for their own safety and functionality, and they're thinking about the future, and that future they have in mind may never come,
Yeah.
right? Yeah. Well, great. How do people get a hold of you if somebody did want to refinance, get a second mortgage, get a HELOC? How would they get a hold of you, Julie?
Yes, a couple different ways. Phone, email, usually are the best. You can follow me on Instagram. So phone number, office 216-466-8224. Email is Julie Eccleston at Rocket Mortgage. And then on Instagram, I am at Julie Eccleston ELO.
All right, great. Well, thank you so much for
Yes,
sharing your
thank
time and
you.
your wisdom, and hope you have a wonderful 4th of July.
You as well.
God bless America.
Yes, thank you.